Hi, my name is Davin Sundvik with Sundvik Realty, and we're going to be going over part 2 of our leverage series talking about loans today. We're going to be talking about refinancing and how to use other people's money to make even more money on a piece of real estate that you already own. We're going to go into 3 main topics today. We're going to be going over how and when to use these strategies, okay, and whether or not it's worth waiting. We're also going to go over whether we can refinance and purchase other properties and whether that's a good idea or not. And third, we're also going to be going over how to refinance a property with a lower interest rate and whether or not we can project that into the future. Okay. For full transparency, we're in the middle of a 5-section series. Okay, we talked about passive income, price growth, tax advantages, massive income opportunities, and now we're talking about leverage in real estate. So if we talk about anything that you don't understand, please look to those previous videos for a little bit of context, because we're assuming that you've watched those videos and have a basic understanding of the other ways to make money in real estate before we go into loans and leverage. So with that being said, again, make sure you watch part 1, the static side of just assuming that you buy a property, you get a loan on it, and you pay the loan over 30 years. Make sure you understand that first before we get into refinancing, because we're going to be building off of some of those basics. So consider that as like the 101 video. This is going to be the 201, a little bit more intermediate, a little bit more advanced, but don't be afraid. We're going to do this together. All right, with that being said, let's convert over to the computer, and I'm going to share my screen with you, and I'm going to show you the actual historical data of how real estate and interest rates have performed over the last 30 years, 50 years, and even 200 years. Okay, so we are recording our screen right now, and what we have up is the U.S. price index since 1900. And as you can see in the early 1900s, we have a fairly flat line, and that's just because that when you represent a growth curve, which everything that has compounding interest has a growth curve, the most recent years represent a significant portion of the growth compared to the older years, right? So it's very hard to see. But you can see that in 1930 to 1932, there's a little bit of decline in the economy. In 1940 to 1941, there was a slight decline. In the 1950s, we had some flat growth where the growth didn't grow as fast as in the 40s. In 1983 or 1982, we had the hyperinflation bubble, but right before hyperinflation hit, we did have a little bit of a decline. 1991, 2008, and most recently, we've had the COVID-19 / 2020, 2021 crash and recovery. So with that being said, real estate really only declines maybe once every 10 to 20 years. So we don't want to necessarily be making our buying cycle with that in mind. Okay, so let's look at interest rates to see how that affects things. All right, here we have the last 50 years of interest rates, and I'll put it in context in a little bit. But as we can see, most of the time interest rates are actually above 7%. So if you have a loan and you have a 7% interest rate, okay, there are going to be opportunities in the future where interest rates are beneath 7%. It does happen. Now, do we go through periods of 10 to 20 years where interest rates don't ever go beneath 7%? Yes, it happens, but it's not super common, okay? Versus you can see there's areas where, and hopefully I'm using a program here that records my screen, and they've got a watermark, so I'm very sorry if the watermark is blocking this portion of it. But as you can see, in more recent years, in the last decade, we've had much lower inflation, which means that we've tried to keep interest rates low to encourage more inflation to happen, because inflation was actually too low. And because we've dealt with such serious recession over the last 10 years, what's essentially happened is you got a situation where people are financing their properties at 3%, sometimes 4%, or even 2%, and the odds of getting a better interest rate than that are extremely low, okay? We don't ever expect that to happen. So let's visualize this under just a slightly longer term period of time. Here we have, since the 1800s, what interest rates have been doing, okay? And this is the 10-year Treasury bond yield, okay, which is going to be probably about 1% lower than a mortgage rate. And as you can see, in the early 1800s, we've got rates in the 6 to 8% range, okay, which means mortgages would have been in the 7 to 9% range. Then towards the mid 1800s, it drops a little bit. Towards the early 1900s, it drops again, okay? And there's little spikes along the way. And then we have a big spike in the early 1900s. Then we have another drop again in the mid 1900s. Then in the 80s, again, when we dealt with hyperinflation, we tried to slow it down with high interest rates to essentially punish people and say, hey, stop buying assets. And then we've moved on to our most recent 30 years, where interest rates have been much lower on average and inflation has been much lower on average over the last 30 years. So just understand that we're in a trend of, on average, low inflation and low interest rates, and that in the future we're probably going to have to correct from this, and we're going to have high interest rates and high essentially inflation in order, for those interest rates to go up. So just understand that we're in a trend of low interest rates and low inflation, and that in the future we probably will have higher interest rates. So understand that if you're watching this video right now and interest rates maybe are 8, 9, or 10%, well, you've probably some time has gone by since I've recorded this video, and you're in probably a really good buying market to assume that interest rates will drop again. Right now, as I record this video, interest rates are between 6 and 7%, and they're on their way down, but they might not be on their way down for forever. They might just be down temporarily and then go back up again. I don't know what you're going to experience in the future as you're watching this, but I just want the concept to be understood first. All right, let's go over to our investment calculator and let's plug in some real life examples. All right, I'm going to plug in $1 million just so we have a baseline for how real estate performs overall. All right, I'm going to put the market interest rate at 7%. Inflation is going to be 3%. That's just the average over like the last 110 years. It's 3.25%, but we're using 3% just to make the numbers a little easier. And so we're going to assume a down payment of $200,000 of 20%. So let's see where our projections lie. Let's see after 1 year what our profits look like. Because in year 0, we're putting in our down payment. There's not really a lot happening in the first year in real estate. So we can see that our return on equity is 13.59%, which is really good. It's really hard to beat that yield right there. And our cash flow is negative. We've got negative cash flow of $5,000. This is even after tax advantages and everything. We've got negative 2.35%. Now, I don't want you to be afraid here, okay? If you're a homeowner, all right, these numbers are all going to look different depending on if you're an investor or a homeowner, and you may not be buying $1 million property, okay? I just want to use the numbers as an example to prove my point here. This is not necessarily a perfect representation of what you're going to be experiencing in the future, okay? Now let's look after 10 years and see what happens. After 10 years, we've got $5,500 positive cash flow, and that's a cash-on-cash return of 2.51, which is not too bad. We've got positive cash flow. This is great. Now, after 20 years, which is when real estate really starts to take off, you can see we've got 9.1% cash-on-cash returns. I want you to remember this because we're going to use a couple of examples here soon to see if we can beat that number, all right? All right, then there's going to be 2 ways that we're going to try to beat it, all right? We're going to try to beat it by refinancing after 10 years, and we're going to assume that interest rates stay the same, and we're going to buy a second property and see if we have more or less cash flow after 20 years, which in our next example will actually be after 10 years. So let's look and see how value of property is after 10 years. We're going to say after 10 years at 1.34 million, we're going to take 20% equity out, we're going to buy another building, all right? And this is a very rough estimate with these numbers, okay? So please don't take like any investment advice just off these numbers here. But as you can see, we are going to pull out $268,000 in refinance, all right? And so now we're going to own two properties, each of them being worth 1.34 million, right? So we're buying real estate with other real estate, and let's see how our projections look. You got to remember, we've already owned this for 10 years, and we are now restarting the cash flow projections here. Our cash flow is negative $6,000, which is a negative cash on cash return of 2.35%. And after 10 years, let's see where we're at. Well, after 10 years, we've got 2.51%, which is very similar to our other 10-year return. And if we double this, because we own two properties, right, we're still only at 5% cash on cash return. If you remember, our other property, we're getting almost 9% return. So it's actually better for your cash flow just to hold on to a single property. And if you want more cash flow, then just invest in more real estate with your own cash and your own down payment. Okay, not using your property to buy other property. Now, I'm not saying that you can't do that and that there aren't benefits, but those benefits come later on down the line. Those benefits come 30, 40 years down the line. It doesn't come 10, 20 years down the line. All right. With that being said, let's go back to our $1 million property. And we already know what our return on investments are, or our cash on cash return is at the 0, 10, and 20-year mark. Let's now look into it, and let's say that we refinance after 10 years or sometime within the 10-year window. And we are, if you remember amortization, we're going to be using the same amortization schedule, which means that if we were 3 years into our loan, we're not going to re-extend the loan to another 30-year loan. We're just going to say, hey, if we refinance 3 years in on a 30-year loan, that's 27 years to go. We're going to refinance at another 27-year loan, okay? And it's just to make the numbers as comparable as we can possibly make it, all right? So, sorry, I typed in 3%. I should have typed in 5. The reason why I'm using 5 instead of 3% is I don't know if rates will go down to 3% in the future, but statistics do show that in long-term periods of time of 100 years, okay, 5% interest rates do actually happen. And even in the last 50 years, 5% interest rates do happen, okay? So we're going to say that we can, refinance and get a better rate. Let's see what happens. All right, now we can see after 10 years, instead of just getting a measly 2.5% cash on cash return, now we're getting a 6.43% cash on cash return. And after 20 years, we are getting a 13.44% cash on cash return. Now, the question here is if we could have either refinanced and made the deal better, or is it better to wait until prices go down? Or wait until interest rates go down? Well, as we said, prices rarely go down, and they're only down in the temporary, even if they do. And 2008 was like a black swan event. This does not happen often, okay? So expecting another 2008 is not a really good idea. Now, waiting for interest rates to go down, we know that that does happen, but let's see what inflation does to property values. All right, let's say 10 years go by and we're waiting for the next dip in interest rates, and we wait. So 1.34 million. We're putting 20% down, so we've got a down payment of $268,000, all right, on a 5% interest rate. Let's see what happens. Well, as you can see, we actually still have some negative cash flow. All right, negative taxable income does come from negative cash flow, but we are getting a little bit of a tax break, and that is giving us positive cash flow of 1.03%. Remember, this is after 10 years. So after 10 years, we could have had a 6% return on investment, but instead we waited 10 years and we reset, and now we only have a 1% cash on cash return. Okay, so and now after 10 years, we got 6.43%. So you essentially are getting instant cash flow by buying when interest rates are low, but you have to compete on price because more people are purchasing. You have to deal with inflation, and you have to put a bigger down payment down because of it. So you're essentially just delaying your profitability by waiting for interest rates to go down. But as we said, 7% interest rates are fairly average. And sometimes things happen where in a 10-year period of time, interest rates don't go down. So what's the worst case scenario if you wait? Well, the worst case scenario is that interest rates actually go up, right? So let's say that they go up to 9% by the time you want to buy, right? You wait 10 years and let's see what happens. Well, as you can see, your cash on cash return is extremely negative, okay? You have negative cash on cash return of negative 7.16%. You now have to wait even longer in order to get positive cash flow, all right? Only after, let's see, 13 years do you get positive cash flow under this set of scenarios, okay? So I'd much rather you, when you can afford real estate to purchase, whether it's a home, whether it's an investment property, it really doesn't matter. These principles all play out the same way. Now, understand that I put in a very specific case study here. Just because I put in a certain set of numbers doesn't mean that you're going to experience negative cash flow, okay? Every single market's different. Every single buyer is different. Everybody has access to different interest rates, and I can't control that necessarily, okay? So the best thing that you can do is actually consult an expert between a real estate agent who actually understands real estate investment strategy and understands how to project real estate growth, and working with a qualified lender who understands how to get you the absolute best loan for you, not just the lowest monthly payment, but the actual best loan for you that's going to give you the best return on equity, which is what we want, okay? We'll do a more advanced video in the future talking about return on equity and how to optimize it. I just wanted to show you how loans affect your cash flow and how you can make a good deal even better if you're an owner and you just decide to buy today and wait and allow your loan to essentially lower its balance, lower maybe the interest rate changes, and it's actually better to own a property, let the interest rates go down and refinance than it is to try to wait for the market to go down, because while you're waiting for interest rates to go down, prices are still going up. So I do appreciate you for watching. I hope you learned something in this video. I know it was long and it was a little bit complicated, but I think you can make some comments down below and we'll make some shorter content and expand on some of the intricacies in more detail in a shorter form. Appreciate you for watching, and we'll see you guys